Okay, guys. It's a question for Casper. It's an interesting question, but it's also one that you've got to be a bit careful with. So it's a little salute to you, kid. Now, the question itself is sort of during the morning call, we're talking about correlations. Now, correlations, you've got indirect correlations and direct correlation. Give an example. A direct correlation is gold versus the dollar. Okay, so if you've got gold and USD JPY, they're directly correlated. If one's going down, the other one will be going up, sort of thing. You've also got indirect correlations, which is, say, gold against an index, because they're both completely different, but one's fear, one's greed. And you can kind of get a view of what a market sentiment is by looking at gold. So if gold's going up, in theory, the indexes should be coming down, but at the minute, they're not. So why is that? It's because they're indirectly correlated. They're not pitted against each other. See, when gold and the dollar are against each other, it's because gold is purchased in dollars. So they're directly connected. But you don't buy gold with shares. Okay? Now, in the question here, it's the pound USD and the euro USD move very similar. And I can see what you're talking about, that if one pair is moving up and the other one is moving down, can you anticipate a move on the other? You can to a degree, but then it becomes a little bit dangerous and a little bit more complicated. You're better off looking at its direct counterpart. So if you're looking at the euro dollar, look at USJPY and see what's happened. Because if there's a huge spike upwards on that USJPY, that means the balance of power on the euro USD will tip. So if the dollar's going up, it will naturally push the euro down. And that's where I would focus my attention on, rather than sort of going, well, I think the pound's moving up, therefore the euro will follow. You can, but then you're starting to look for things that mightn't be there. So I would avoid that altogether. And personally, the way I trade is I pick one asset and then I don't even bother looking at the other one. I just study that single asset. Now, this has opened up another question, though. Not necessarily on the Forex markets, but on the indices markets. You have the S&P 500. Now, the S&P 500 is the daddy of all the indices, and the indices genuinely follow it. So if you see there's a big move on the S&P and it hasn't happened on the DAX or the FTSE, etc., then there's a fair chance it may be coming, and you could start looking to position yourself to get in it. But if you're working hour to hour to hour, just stick with the chart you've got and you'll be fine. Okay, hope that helps.